Hey there and welcome back to the channel. In this video we're gonna be analyzing a company called Autozone, which is a specialty retailer of auto parts. Now as a value investor, I'm usually not excited when it comes to retailers. It is a really tough business with low returns on capital and low margins. But AutoZone is a different company like you'll see in this analysis. But if you get any value out of these videos, remember to smash the like button and subscribe to the channel if you haven't already. Now, when we are analyzing a company, there are basically four things we're looking at. We are trying to understand what the company does, how they make money. We're trying to understand if the company has some kind of competitive advantage. Do they have a moat? We're checking if the management team has any skin in the game and are they good at allocating capital. And the fourth thing we check on is the intrinsic value of the company and at which price we are willing to buy stock in the company. Now, when looking at any retailer, we are basically trying to figure out two things, with the first one being same store sales, both domestically and internationally. And then we're also trying to figure out how many stores the company is planning on opening in the next couple of years. Now, the same store sales for AutoZone were not that impressive, with the total company same store sales being 4.6% and only 3.4% for their domestic stores, with the international same store sales being much stronger at 17.5%. Now, as we saw, AutoZone is seeing most of their growth internationally as they do already have 6,300 stores in the US. And for the fiscal year 2023, the company opened up 197 net new stores compared to 176 in the prior year. There are some good news for current shareholders and for those of you thinking about buying into AutoZone is that they plan on accelerating the pace of their store openings and aspire to open as many as 500 stores annually 5 years from now. So by fiscal 2028, they are modeling 500 store openings with a split being 300-200 between the US and international. Now, the auto parts retailing business is basically split into two parts, with the first one being do it yourself and the second one do it for me. The do it yourself business is where customers come to the store and buy things they plan on putting on the car themselves or have someone at the store help them. And the do it for me business is a business where the company sells to mechanics. Now, these numbers are a bit dated, but as we can see, AutoZone is the strongest player in the market when it comes to do-it-yourself. They have a 14% market share compared to their biggest rival O'Reilly, which has 9, and their second biggest rival Advanced Auto Parts, which has 7. Now, in my opinion, there are growth opportunities in the do-it-yourself market, where 63% of the market currently belongs to small mom and pop stores, which the bigger players can buy out in the next couple of years. Now, the do-it-for-me market share is a bit different than do-it-yourself, where AutoZone is a much smaller player than O'Reilly and Advanced Auto Parts. This number is probably closer to 4 or 5%. I think these numbers are about 3 years old, but definitely a lot of growth opportunities for AutoZone to get a greater market share in Do It For Me. Now, I have a checklist of 117 items I go through when analyzing a company. I will show you some of the highlights from that list, and we will then end the video by giving the company a total score. Now, the next thing I want to show you is a question that I have on the checklist, which is could the company be disrupted by a lower cost competitor? And I think this is a definite threat to AutoZone, where they could see a player like Amazon or Walmart come into the game and try to undercut them on price. And I do think that is one of the reasons why the company has been trading at such a low multiple for the last couple of years. I also want to mention another risk for the company, which is definitely the increasing adoption of electric vehicles. As more and more vehicles become electric, customers are likely to buy their auto parts straight from the manufacturers, like in the case of Tesla. Next up, we're going to look at the financials for AutoZone, which are pretty impressive. And if you go to QuickFS, you can see the 10-year median for revenue is 6.7% CAGR per year and 8.1% for free cash flow. But AutoZone is really a company you want to take a look at the growth on a per share basis, where we can see that their 5-year revenue growth is 18% per share and 16% for the last year. EPS growth is strong at 22% for the 5 years, and free cash flow as well at 17%. AutoZone has, however, seen a decline in their free cash flow growth for the last couple of years, which is definitely something to think about when analyzing the company. I do have both AutoZone and O'Reilly's on my watch list and have been checking out both companies for some time now. So let's compare AutoZone and O'Reilly's now, since they are pretty similar. We can see that the free cash flow, both for the 1, 3-year and 5-year, is stronger for O'Reilly's. Both companies are trading at similar enterprise value to free cash, and both AutoZone and O'Reilly's have strong returns on invested capital and strong return on capital employed. Their growth margins are similar and are pretty stable, but both companies have an operating margin of around 20, which is growing for the last 5 years. O'Reilly's has a stronger free cash flow margin. They both have a fairly low current ratio, but O'Reilly's has a higher interest coverage ratio, and both AutoZone and O'Reilly's have been buying shares back like crazy for the last couple of years. I would say when comparing the financials of AutoZone and O'Reilly's, that O'Reilly's is a stronger company, although AutoZone has a bigger share in the do-it-yourself segment. Now, next up is evaluating the management team of O'Reilly's, where William Rhodes is the CEO of the company and has been for almost 20 years. Unfortunately, as of January 2024, he is stepping down as CEO, which is bad news for the shareholders. And William is being replaced by an AutoZoner called Philip Daniel, which I can't find on this list at least. But we can see that William Rhodes has plenty of ownership in the company, but the same thing cannot be said about the rest of the management team or the board members of AutoZone. Now, if you take a look at the reviews on Glassdoor to try to find out what the culture is and how the staff likes working for AutoZone, we can see that there are 6,500 reviews, which is pretty much, so these numbers should be pretty accurate. The company unfortunately only gets 3.4 stars. Only 55% would recommend the company to a friend, and Bill Rhodes, the third, the CEO, only gets approval rating of 61%, which is not that high. As we can see here, their rivals aren't scoring that high either, with Napa Auto Parts getting 3.6, Advanced Auto Parts 3.3, and O'Reilly's 3.3, which is similar to AutoZone. Now, a question that I always like to ask myself when investing in a company is if an investor that I respect and follow owns a meaningful stake in the company. Unfortunately, in the case of AutoZone, I couldn't find any ownership of a guru that I know of, but O'Reilly's is famously owned by Chuck Akre in his focused funds. And O'Reilly's has been a really big winner for Chuck Akre and his clients. Now, before we stop discussing the topic of management, I do think although the CEO, which has been really good for AutoZone, is leaving the company, I think the management is still really shareholder aligned. If you take a look at their emphasis in the last earnings call for Q4, we can see that they are emphasizing powerful free cash flow generation and disciplined capital allocation, where they are investing to optimize performance of existing assets, driving growth, and returning excess cash to shareholders in the form of buybacks. Now, I do want to point out one difference between the business model for AutoZone and the traditional retailer. And I can see the difference in the numbers if you look at days inventory, which is pretty high for AutoZone, and it measures how long the inventory stays with the company. But I would personally rather invest in a company like AutoZone or O'Reilly's, where they have higher margins but have a slow turnover for their inventory. Now, AutoZone is called a cannibal for a reason. If you look at their share count in 2014, they had outstanding shares diluted of about 34 million, which has gone down to 19 million as of end of fiscal 2023. Now, I do think that the buybacks are a much better way to return capital to shareholders instead of using dividend, especially when you can buy your shares back at a multiple similar to what AutoZone has been trading at for these last couple of years. But you want to have a healthy mix of the two, like AutoZone has been doing, where they've been putting money into opening new stores and improving their technology around their logistics with their hubs and mega hubs. And all the money that they don't use, they give back to shareholders, which is a pretty good deal in my opinion. Moving on to the final part of this video, which is trying to find out the intrinsic value of the company before we give AutoZone a total score. The first thing that we're going to take a look at is the Francois Rochon of Giverny Capital valuation test. AutoZone has free cash flow per share of $112, which I think is pretty likely they'll be able to grow at 10% for the next 5 years, which would give them a free cash flow of $180 per share in 5 years. Now, if we apply a similar multiple to what the company has had on their free cash flow for the last 5 years, which is 20, that would give us an intrinsic value for one share of $3,600. Now, remember, we have to divide that by two to have a margin of safety where we get $1,800, and this number has to be at least a little bit higher than the current share price of AutoZone. Unfortunately, AutoZone is trading at $2,500 with a market cap of 45 billion. Now, the price to free cash flow to growth is a ratio that I came up with by myself, which is similar to the Peter Lynch price to earnings to growth. Now, it is a pretty simple ratio where we want to see the growth in free cash flow for the last couple of years being a higher number than the price to free cash flow, which is unfortunately not the case for AutoZone. The last valuation method that we'll be using in this video is the discounted cash flow analysis, where we will apply a 10% discount rate and use a growth in free cash of 8% per year for the next 10 years with a terminal growth of 4%, which gives us a fair value of $1,700, which is way below the current stock price. That gives the company a total score of 70, which is pretty decent, nothing to get overly excited about. I personally would pick O'Reilly's over AutoZone if I were to make an investment in this industry, and I might do an analysis video on O'Reilly's pretty soon. That's it for the video today. Remember to like and subscribe if you haven't already. Thanks for watching, and I will catch you on the next one.